Greetings from Awesome 5-Star Metals. My name is Ty Chapman and welcome to your 5-Minute Fridays, where we try and give you all the news that affected the world economy, U.S. economy, and oil and oilfield services this past week. So let's jump right into it. U.S. economy got some good news. U.S. durable goods orders, excluding aircraft and defense items, was up 4.1% for the period January to March. That's compared to a 3.1% increase for the same period last year, but down from the 8.3% growth we saw in June through August. Employers added 263,000 jobs in April, which beat estimations of 185,000. Overall, the unemployment rate has fallen to 3.6%, the lowest level since December 1969. However, U.S. manufacturers did seem to confirm somewhat of a slowdown. According to the Institute of Supply Chain Management, the Business Activity Index fell to 52.8% from 55.3% in March, and that is the lowest level since October 2016. U.S. manufacturers reported production orders and employment growth were all down from summer highs, and inventories are rising faster, and supplier deliveries are speeding up. Core inflation remained pretty good. It rose just 1.6% in March, down from 1.8% in January and 2% in December. However, I would note that the Federal Reserve targets a core inflation rate of around 2%. Not enough inflation is actually seen as bad for the U.S. economy. However, the Federal Reserve did decide this week to hold interest rates at their current levels, and Fed Chairman Jerome Powell noted, quote, "The overall economy continues on a healthy path, and the committee believes that the current stance of policy is appropriate." That issue with the core inflation is probably related to lower cost of imports and a slowing world economy, as well as TVs, frankly, went down to their lowest price level in years. So some of that is probably affecting that rate. Chinese manufacturing activity, according to their Purchasing Managers Index, fell slightly in April as opposed to March, but basically remained flat. On to steel. Some interesting news about steel. One thing that is currently a big sticking point in the United States-Mexico-Canada free trade agreement is steel tariffs. Both Mexico and Canada have indicated that they will not sign the new USMCA as long as 232 tariffs remain in place. But according to a study by George Mason University, a few interesting notes on that. The U.S. Department of Commerce received made an increased number of decisions on exemptions last month as compared to prior months, but U.S. steel manufacturers also increased their objections. Objections are particularly relevant because exemptions are unlikely to be approved in the face of an objection from a domestic manufacturer. However, the study noted that the aggregate steel volume filed in the objections, i.e. what domestic steel makers said that they could make, far exceeds their production capacity, which calls into question the validity of some of those objections. Another interesting note is that the amount of exemptions granted to China exceed the amount of exemptions granted to Canada and Mexico combined. So whereas China was maybe one of the driving forces for these tariffs, it seems like the U.S. Department of Commerce is not acting as though it, in fact, was a driving force. Another interesting thing is, according to Rystad Energy, steel demand is set to increase because more than 1 million kilometers of new oil and gas wells will be drilled in the next 5 years. Which is about 25 times around the equator. So that's pretty interesting. On directly to oil. Saudi Arabia gave us some indications. As some of you may know, Saudi Arabia and the United Arab Emirates agreed to increase production to help offset any production loss from Iran as a result of the Iranian sanctions. However, the Saudi oil minister told Russia and the press that he would like to see the current cuts that are currently expected to expire at the end of June extended through the end of the year. So they seem to be wanting to hold current production quotas, and that should be an interesting as it plays out. The number of drilling rigs has fallen about 9% from its cyclical peak in November. So we see a falling rig count. We'll talk about what the rig count was this week later. But I want to take an in-depth look at crude inventories this edition. U.S. crude production fell for the second month running by about 187,000 barrels in February. It also fell by 93,000 barrels in March. Overall, crude production is down about 300,000 barrels per day from its cyclical peak in December, according to the EIA. And the lower offshore production of Gulf of Mexico accounted for approximately 187,000 barrels of last month's decline. So we don't actually see shale and shale formations production declining that much. Most of the production decline is actually coming from offshore. But there is no doubt that U.S. crude production has decelerated. Output was up about 1.4 million barrels a day in February compared to the same month a year earlier, but down from a record increase of 2.1 million barrels per day in August, and down from the 1.8 million barrels per day in August through September, which is the first time it's significantly slowed down since 2016. But one thing that seems to be causing some confusion is stocks. As I've noted before, inventories keep rising, and U.S. commercial crude inventories have actually risen by almost 30 million barrels since the start of the year. But that's compared to an increase of just 12 million barrels for the same period last year. But that, I want to note, that is well below the seasonally adjusted average increase of about 45 million barrels for this time of year. So what's going on? U.S. refinery crude processing is down significantly. It only ran about 16.45 million barrels per day last week, and that's the lowest level since 2016. U.S. refineries are doing heavy maintenance right now, and on top of that, there's some new diesel restrictions on low sulfur for shipping, and that's causing them to have to do some retooling. So it kind of makes sense that the overall production's down, why they retool for that. So I want to make a conclusion. So the limited increase in U.S. commercial stocks, despite the heavy maintenance season, seems to confirm, in fact, that inventories are actually adjusting and that we do face a potential shortage in the second half of the year. When you look at that in relation to the amount of oil the United States produces, it's really not that surprising. The United States has produced about 211 million barrels in the first 17 weeks of the year, but approximately 239 million barrels have not been imported and have been taken off market from outside sources. So inventory is actually declining. It's just very hard to see it right now. I think we'll start seeing more inventory declines once summer driving kicks off, and we'll have a real take on whether the market is oversupplied, undersupplied, or about where it should be. One interesting note is that President Trump does appear to be serious in terms of keeping oil supplies up. There was a release from the Strategic Petroleum Reserve of about 539,000 barrels. And while that number is not really significant in the overall scheme of things, it does show that we are willing to tap into inventory supplies in order to keep oil markets balanced. The active rig count in the United States stabilized this week, falling by 1 to 990. Oil rigs were actually up by 2, going to 807. However, oil rigs are down about 9% since its cyclical high of November. So we'll continue to monitor and see what happens. That is your 5-Minute Friday. As always, thank you for your business. Thank you for your support. Thank you for your friendship. Let us know if there's anything we can do for you. Take care.